Welcome to The Explainer. I'm so thrilled you're joining us today because we are tackling one of the most fascinating mechanisms in all of modern finance. Seriously, if you've ever watched a company go public and thought to yourself, how on earth did they land on that specific share price? Well, you're exactly in the right place. So let's just dive right into it. Today, we're using the draft red herring prospectus, or DRHP, of Indo-MIM Limited as our real-world case study to completely decode this IPO mystery and figure out exactly how the book-building process actually works. It's the ultimate million-dollar question, right? Or, well, in the case of Indo-MIM Limited, the 10,000 million rupee question. When a company decides to launch a fresh issue of shares to the public, those shares have literally never been traded on the open market before. There's no ticker tape. There's no historical daily chart to look back at, so valuing a company and setting that absolute initial entry price before a single trade even happens, that is a massive, massive challenge. To unpack this incredibly dense financial machinery, here is our roadmap for today. We'll start with the IPO pricing mystery, then look at what book building actually is, move on to the key players involved, see how bidding actually works, explore finding the final price, and finally wrap up with why this matters to you. All right, let's jump right into Section 1, the IPO pricing mystery. You see, the final offer price for an IPO isn't just, pulled out of thin air in some smoky boardroom. It requires a really systematic approach. To see why, let's look at the actual data from Indo-MIM. They're issuing up to 10,000 million rupees in a fresh issue of shares. Now, we know the face value of each equity share is exactly 1 rupee, but the actual market value, the price you and I would actually pay, that is the real wild card. The offer price is eventually going to be some multiple of that 1 rupee face value, but to find that multiple, we need a mechanism. Which brings us to Section 2. What is book building? Basically, the book building process is like a giant, highly regulated market survey. Instead of a company just dictating a price and crossing their fingers hoping people buy it, they go to investors and ask, hey, what are you willing to pay and for how many shares? By collecting all these bids, they can assess the real, on-the-ground market demand to discover a fair offer price. Ultimately, it's the demand that dictates the final price tag. But to keep this survey from just descending into total chaos, the company sets up a price band. Think of it like a fence. On one side, there's a floor price, the absolute minimum bid allowed. On the other side, there's a cap price, the absolute maximum. And what's really interesting here is the regulatory rule behind it. According to our source material, the cap price has to be at least 105% of the floor price. But, and this is key, it cannot be greater than 120% of the floor price. This creates a neat, structured little pen for investors to bid within, making sure the price isn't wildly spiral out of control. Moving right along to Section 3, the key players involved. A process this massive, we're talking about coordinating billions of rupees and thousands of investors. It requires some heavy-hitting managers. Meet the orchestrators, the book-running lead managers, or BRLMs. For the Indo-MIM IPO, we are talking about major financial institutions, heavyweights like HDFC Bank, Axis Capital, ICICI Securities, Kotak Mahindra, and SBI Capital Markets. These guys are the real engines behind the IPO. They do the due diligence, structure the capital, and draft those massive 1,000-page prospectuses so, you don't have to. Ultimately, they're the ones managing the book and finalizing the pricing. But who exactly are they collecting all these bids from? Well, the shares aren't just thrown into a giant free-for-all mosh pit. The offering is meticulously sliced up. Under Regulation 6.1 of the CB regulations noted in the DHRP, a maximum of 50% of the net offer goes to qualified institutional buyers, or QIBs. Think mutual funds and giant institutions. Then, non-institutional bidders get a minimum of 15%. And finally, the retail individual bidders, the everyday folks like us, are guaranteed a minimum of 35% of the pie. So everyone gets their specific designated slice to bid on. Okay, Section 4, how bidding actually works. So here's a fun fact. The bidding doesn't actually start for everyone at the exact same time. There's totally a VIP line. The company, consulting with those BRLs, can allocate up to 60% of that institutional QIB portion we just talked about to what are called anchor investors. These are massive institutional investors who get to bid exactly 1 working day before the bid opens to the general public. And once they submit, they cannot withdraw or lower their bids. No backing out. Their early participation essentially sets the momentum and builds market confidence for the rest of the book before the public even gets a chance to log in. But when the public does finally log in, how does the money actually move? It happens through a really brilliant system called ASBA, application supported by blocked amount. Let's bust the jargon for a second. When you, as a retail bidder, submit your bid, you don't actually send your money anywhere. Instead, you just authorize your bank to block the funds in your own account. Your money literally stays right where it is. It isn't officially debited until the very end, and only if shares are actually allotted to you. If you don't get the shares, the block is just lifted. Simple as that.
Next up, Section 5, Finding the Final Price.
So the book is closed, the bids are in, the funds are blocked. This brings us to the climax. How do all these thousands of bids translate into one single definitive number? Well, finding the offer price is kind of like an intersection of art and science. The BRLMs and the company don't just blindly look at bid volume. They take that market demand and balance it against hard, quantitative facts. The prospectus outlines this specifically. They look at basic and diluted earnings per share. For example, Indo-MIM listed a basic EPS of 8.79 rupees for March 2025. They weigh their price-to-earnings ratio against industry peers. They look at the return on net worth, which for Indo-MIM sat at a really healthy 19.94%. They balance all these cold, hard numbers against the public's bidding enthusiasm to finally lock in that offer price. And guys, this happens incredibly fast. Here is the typical rapid-fire timeline. 1 working day before the public launch, the anchor investors drop their massive bids. Then the bid period opens for everyone else, usually for a minimum of 3 working days. Once it closes, the company and BRLMs crunch the data we just talked about and finalize the pricing date. And then, amazingly, within about 3 working days from the bid closing date, all the formalities are done and the stock finally hits the exchanges for live trading. Finally, let's wrap up with Section 6, Why This Matters. Let's just step back for a second from all of this dense financial plumbing. Why should you even care? Because these regulations aren't just boring red tape. They are highly elegant mechanical safeguards designed entirely to protect everyday retail bidders like us. The cap price limit makes sure that institutional hype can't drive the IPO price so high that retail investors end up vastly overpaying on day one. And that ASBA mechanism, it ensures your hard-earned capital stays safe, secure, and crucially, continues to earn interest in your own bank account until the exact moment you are confirmed to get shares. It completely removes the risk of handing your money over to a third party while you wait. But I want to leave you with a bit of a provocative thought today, one that's actually highlighted as a major risk factor right inside the Indo-MIM's DRHP. The book building process is a fantastic way to figure out the initial offer price. But as the prospectus explicitly warrants, that determined price should absolutely not be considered indicative of the market price after the shares actually list. Once that opening bell rings on listing day, the safety net of the price band is gone. It is just pure open market supply and demand. So the ultimate question is, the BRLMs and the company did the math to find a price, but will the open market actually agree? That is the ultimate test of a stock's true value. Thank you so much for joining me on this deep dive into IPO book building. Keep questioning the numbers, and I'll see you in the next explainer.